Well, good morning, everyone, wherever you are catching this webinar. It's a pleasure to have you with us today as we have another in our series of Working in Australia. And today's a very topical issue for many employers. It's in relation to superannuation compliance. So before we get underway with all the details, let me just cover a couple of quick housekeeping points. So we would love to get your questions as we're going through the session, and there's a tab on the side of the screen where you can drop your questions into, and we'll try and get to as many of them as we can during the session. If you're having any troubles, there's also a help support section there where you can click through. And finally, after the session concludes, we will send through a follow-up email which will attach the slides, a link to the recorded session so you can go over it again and pick up those really key points you might have missed as we went through. You can also get access to the other webinars that we've run as part of this series, and also our contact details in case you have any follow-up questions. So I'm James Trainer. I'm a partner in BDO's tax practice in Sydney and specialise in employment taxes and things like FBT and superannuation and payroll tax. So hence why I'm with you today. Also joining us are Ben and Stephanie. Ben's a director here with me in Sydney, and Stephanie's a senior manager in our Melbourne office. So we look forward to hearing from both Ben and Stephanie as we go through today's session. So what are we going to cover? Well, I'm going to go through a little bit of an overview of superannuation compliance, a little bit to set the scene. Then Ben's going to take us through some issues around superannuation remediation and some of the traps that we've identified as we've been doing this work and assisting our clients meet their obligations. And finally, Stephanie's going to talk to us about payday superannuation and the changes that are coming and that really employers need to start thinking about now so that they can be ready for the challenges. Even though it's a couple of years off, there's a lot that can be done now. So firstly, just touching on super guarantee compliance. And the slide here is something that the ATO put out just recently, and it's a snapshot around super guarantee compliance in the 2022-23 year. And there's a lot of information on this slide, but just a couple of things I want to call out. So firstly, the tax office has a look at the gap that it identifies between what it thinks employers should be contributing to super and what's actually going into super. And the gap that it's identified is about 5.1%. That translates to about $3.6 billion of superannuation that's not getting its way into super funds for employers. And so, for employees. So there's certainly a lot for the ATO to do in this area. And it's important to note that the ATO, being one of the guardians of the super system, really has obligations to report this information through to government. So it's certainly in their interest to make sure that that superannuation gap is actually shrinking. And so to the extent that it's identifying areas where there might be non-compliance, the ATO is certainly pushing through and making sure employers comply so that it can then present the numbers back to government to say, look, we're doing a great job. We're reducing that gap and we're capturing all of these funds for employees. And that's what a lot of the other stuff there is coming up on the slide. A couple of things that I just want to call out on the slide is that the ATO doesn't need to do a lot of work in terms of its compliance action. So if you look there, most of the compliance activity in the middle there around employee notifications, there's 22,000 odd employee notifications to the ATO during the period. And they acted on a fair number of them, and their goal is to actually act on all of those compliance notifications that come to them. And generally, the ATO is very successful. So if an employee comes to the ATO and says, hey, I think I've been underpaid, generally that's correct. And so the ATO doesn't really need to do a lot of extra effort to make sure that employers are complying or to uncover the non-compliance. It simply approaches the employer, asks a few questions, and then we see the process of the remediation, which Ben will talk about, sort of happen through there. So they're raising a lot of super guarantee obligations. There's also a lot of penalties that are flowing through that. You can see just to the right of that, there's also some initiated cases by the ATO. they're far smaller. But what we're finding through single touch payroll is that the ATO is getting a lot of this information more frequently and earlier. And so the ATO has definitely got a process to nudge employers to do the right thing. So before they actually launch a full audit, to actually go to employers and say, hang on, it looks like you've paid salary and wages, you haven't made any super contributions, what's happening? You need to think about your compliance. So the ATO is certainly trying to get ahead of the curve with employers to make sure that they're actually doing the right thing. One of the other interesting points, if you look down to the voluntary disclosure section in the bottom corner there, is that there's still a fair amount of work that's being done by employers to make sure that they're doing the right thing. And this is where they identified an error in what they've contributed to super and actually going to the ATO and making a voluntary disclosure. And Ben's going to talk a lot about that as part of his section. But the important thing to note there is that whilst the ATO is kind of showing you the amount that's been picked up through as voluntary disclosures, there's nothing there for penalties. And whilst it's possible that some penalties have been raised, the key thing there is that by making a voluntary disclosure, you maximize your ability to put yourself in good favor with the ATO and have the Commissioner waive some penalties. So definitely the Commissioner's looking to recover unpaid super through voluntary disclosures, but in cases where it's been inadvertent and it's not happening a lot, they're certainly more willing to waive some of the penalties that you can see, the Part 7A penalties or Part 7 penalties that apply where it's an ATO initiated compliance action. So certainly a lot of activity in this space, and we'll probably see over time through the payday super that Stephanie's going to talk about, is that it will be harder for non-compliance to actually happen because if super's paid in time with salary and wages, then the ability for employers to sit on funds and then actually not make contributions to super, those chances are going to be lessened. So that's a big part of reducing that super gap that the ATO has identified there. To finish on a positive note though, whilst there is a gap, what we're seeing, or what the ATO is seeing, is that 94% of employers are doing the right thing. So the vast majority of the 900,000 employers are doing the right thing, getting the right amounts into the super funds for their employees. And that's a really positive thing because it's certainly one of the pillars of Australia's retirement process or program is super guarantee. So that's it from me on setting the scene. I'd now like to hand over to Ben to go through some comments around superannuation remediation.
Thanks, James. So I guess before we get into the remediation and the action that employers need to take, just a quick recap on what is employers' obligations from an SG perspective. So as can be seen on the slide there, employers are currently required to make superannuation contributions on a quarterly basis, with the contributions due 28 days after the end of the relevant quarter. So 28 October for the September quarter, 28 January for the December quarter, 28 April for the March quarter, and 28 of July for the June quarter. Now we know the number of employers obviously make contributions more frequently than that, and they do so, on a monthly or fortnightly basis as they, are making the relevant pays to employees. But this is currently the minimum requirement that the contributions need to be made at least on a quarterly basis. So moving on. So what do we need to do if we're in one of those situations that James has just touched on, and we've identified that we may not have actually complied with our superannuation obligations? So to begin with, employers who do not make the super contributions within that 28-day window that we just spoke about are required to lodge what is known as an SG statement with the ATO to correct the issue. Importantly, it is not only the super shortfall that is payable in this instance, that is actually calculated on a broader concept of salary and wages and not ordinary time earnings as super contributions are normally calculated on, which we'll touch on later in the presentation. They're also liable notional interest that's charged at 10%. And importantly, there's no ability for this or the admin fee, which we'll touch on, to be remitted. I guess the policy, policy reason behind that is that the ATO effectively, is viewing this super as, the employees' money. And the 10% notional interest that's charged and is actually payable from the start or calculated from the start of the relevant quarter is effectively designed to, compensate employees for the lost earnings that they, may have been able to attract if the amount was contributed to the super fund in a timely manner. The ATO also charges a $20 admin fee, which is per employee per quarter. And this is designed to effectively process the super guarantee shortfall and statements. Because where we do make this SG disclosure, the disclosure is actually made to the ATO, and they actually, allocate the amounts where we do pay the ATO to the relevant employees' super funds. So that's the $20 admin fee per employee per quarter. If we do this within 28 days, there's no further penalties. However, if we don't do that within 28 days, there can actually be a part 7 penalty that James touched on earlier, and that can actually be levied at up to 200% of the SG shortfall amount. So that's quite a significant penalty, as you can appreciate. There's also separate penalties that can apply for failing to lodge documents under the Tax Administration Act. Importantly, and this I think is a key message, if you don't take anything else away from today's presentation apart from this, is that everyone may be aware there was a super amnesty a couple of years ago where obviously the Commissioner and the government basically legislated for a period of time where employers could come forward and make voluntary disclosures. And in that instance, the admin fee was waived, there was no penalties, and the contribution still remained tax deductible. But following the conclusion of the amnesty, it's now basically in legislation, the Commissioner's ability to remit penalties where there's ATO initiated audit activity is extremely limited. We will work through the process of the Commissioner's ability to remit penalties in the case of voluntary disclosures, which James touched on, where it's likely that where employers do come forward voluntarily, penalties will be remitted, and there is an ATO practice statement that assists employers in considering the relevant factors from a penalty remission perspective, which we'll touch on. But I think the key thing to note there is ATO initiated compliance activity. So if the ATO is issuing an audit, some form of review, the ability, and they find a shortfall, the ability for the Commissioner to remit penalties is extremely limited now following the amnesty. All right, so now we've identified we've got a super issue, so and we know we have to lodge an SG statement. So how do we actually go about completing the calculation and doing the relevant disclosure? So as we mentioned earlier, the SG shortfall is actually calculated on a broader base known as salary and wages and not ordinary time earnings. So put simply, it is not simply 11% of the amount that has not had super contributed on it. There's a separate calculation where we need to work out our SG charge percentage, and then we apply that to the broader salary and wages concept that we just mentioned. So I guess we'll sort of step through here effectively a calculation so people can get a feel for I guess the additional uplift and additional other costs that are involved in an SG shortfall situation. So our example here, the employee was paid a salary of $15,000 for the July to September 2023 quarter. They were also paid overtime of $5,000. The superannuation rate at the moment is 11%. The employer is paid superannuation of $1,500 for the quarter, and they're going to lodge their SG statement on the 15th of November. So the first question or step that we need to analyse is there a super guarantee contribution underpayment? And in this instance, there is. So the actual employer super contribution in this instance should have been $1,650, being 15,000 times 11%, whereas obviously our contribution was actually 1,500. So prima facie, there's a super guaranteed contribution underpayment of $150. We now need to calculate the SG shortfall. So as mentioned, the SG shortfall is calculated as the SG rate for the relevant quarter, less the amount of SG paid divided by the ordinary time earnings times the salary and wages amount. So we're effectively calculating our SG charge percentage in this instance. So in this instance, we bring in the overtime payment of $5,000, as this is considered salary and wages for the purposes of calculating the SG shortfall. And I guess just on this sort of point, there are a few sort of key items that are sort of brought into the net from a salary and wage perspective, where we are doing this calculation, that are not considered OTE. So one of the biggest ones will be overtime, as we've just mentioned, but also, leave paid out on termination and various other payments also fall within the salary and wages net and need to be factored in when undertaking this SG shortfall calculation. So in this instance, our actual shortfall is $220. So as you can see here, the difference, originally just applying the straight rate to the income that we didn't pay super on, we had a shortfall of $150, but the actual calculating the SG shortfall results in a higher amount due to this concept of calculating the SG charge and applying that to salary and wages of an additional $70 that's payable in this instance. So that employers really need to sort of, be aware of that when they're going through the remediation process, and obviously costing, what it's going to cost to make the disclosures and remediation of any super shortfalls, that is actually going to likely be a greater amount than simply the super percentage times the amount that had super paid on it. So then finally, we obviously have the interest and the admin fee. So the admin fee is nice and simple, it's just $20. And then the contribution in this instance was outstanding for half of the relevant period of the quarter, also for 168 days, sorry. So effectively the interest on the 220 works out to be $10 in that instance, but that's the calculation there of the interest. So now we've gone through and we've calculated our SG shortfall amount and we've made our disclosure to the ATO to correct the amounts. There are a few other issues that we need to be aware of and consider. So payroll tax is actually payable on SG disclosures or SG shortfalls. And importantly, it's not just the SG shortfall amount that is subject to payroll tax, but it's the interest and admin fee that's also subject to payroll tax. And the payroll tax taxable wages should be recognised where we make a super disclosure in the month that we're effectively making that SG shortfall. And this obviously contrasts with various other wage underpayment issues that is currently quite prevalent, where organisations are looking at a broader wage compliance, where they do identify a wage underpayment that relates to a previous period. From a payroll tax perspective, obviously need to go back and amend the relevant payroll tax returns to each of which those payments relate. But from an SG perspective, and how that interacts with payroll tax, where we lodge the SG shortfall disclosure, we pick that up for payroll tax in the month that we're making that disclosure. And then finally, as we touched on earlier, an SG shortfall is actually non-deductible from a corporate tax perspective. So whereas you would normally obviously get a deduction for super had you paid it, on time and in line on the correct elements as an employee benefit or employee wage expense, there is sort of that additional penalty or deterrent, so to speak, from the ATO, that it becomes non-deductible from a corporate tax perspective. So just closing before Steph obviously covers some stuff around the payday super proposals. So what does this all mean for employers, and what action should they be undertaking? Where you identify a superannuation shortfall, it's obviously recommended that you look to lodge a voluntary disclosure as soon as possible. As James mentioned, and we've covered earlier, Part 7 and Tax Admin Act penalties can be remitted in the event of a voluntary disclosure. So it's really important for employers to get on the front foot and let the ATO know through lodging a voluntary disclosure where they've identified an issue for that penalty protection. As we mentioned, in the circumstances where the ATO, identifies a super shortfall either through, the employee complaint process or other data matching or records that they have and commence compliance activity, the Commissioner's ability to remit penalties in this instance is extremely limited. And as we mentioned, those penalties can be levied at up to 200% of the super shortfall. So it is a significant cost, and it really does pay for employers to get on the front foot in this scenario. As mentioned, there is an ATO practice statement that outlines the factors that the Commissioner will look at in considering remission of penalties in this instance. So if you're in this space, definitely recommend that you take a look at that practice statement. It has a number of factors, and it gives weightings to the different factors in terms of remission. There's obviously, a weighting to late payment, where the employer's remediated through the use of late payment offsets, but it also considers the employer's previous, record, compliance history, etc., and provides various weightings that go to remission. And it would certainly be our recommendation that if you were lodging a voluntary disclosure, that you would, along with that voluntary disclosure and completion of the SG statements, you would put in a formal set of letter requesting remission of interest, penalties, interest obviously not being able to be remitted in the super space, but remission of the Part 7 and Tax Admin Act penalties, and working through that practice statement that we mentioned. Just finally, there is obviously the employee communication piece, which is key. So, where you do identify a super shortfall, employers obviously need to consider how they communicate that to the employees. The ATO, if you lodge a voluntary disclosure and SG statements, will actually, process that as we've mentioned, and there will be notifications going to the individual's MyGov account. So, it's timely and important for employers to consider, well, what communication, what strategy are they going to, provide, and what information are they going to provide to employees to manage that process prior to, the funds appearing in their MyGov account. And with that, I'll hand over to Steph, who will take us through some of the Payday Super initiatives.
Thank you, Ben and James, and really appreciate your time. Some very insightful bits of information, and thank you to everyone who is joining us this morning as well. So, as Ben and James mentioned, I will be talking about the very popular topic of payday superannuation. So a key focus of the 2023 to 2024 federal budget is the development regarding superannuation guarantee payments. So set to commence on 1 July 2026, employers will be required to remit their employees' super entitlements on the same day as their salary and wages. The goal here is to enhance the efficiency and effectiveness of the superannuation system, ultimately benefiting both employers and employees. The initiative aims to ensure employees receive their super entitlements in a more timely and consistent manner, and also provide regulators such as the Australian Taxation Office to not only enforce compliance, but also identify any instances of non-compliance. Not sure, James, if we can move through the information. That's great. Slide 2. Yep. So what do these changes mean? By integrating super contributions with regular payroll cycles, it basically simplifies the administrative burden on businesses. So for employers, the integration of super contributions with regular payroll cycles means that there's a more seamless and efficient process. And this streamlined approach not only eases the administrative burden on employers, but it also minimises for any potential oversights or miscalculations. So compliance with the superannuation, as we know, is of paramount importance for not only the ATO, but for employers. So this real-time data streamlines the ATO's ability to identify non-compliance and for them to take swift targeted action and to rectify. So it also signifies a major advancement in the ATO's capacity to monitor and enforce super compliance more effectively and regularly, as James mentioned earlier. So failing to meet your super obligations in a timely manner can result in increased penalties imposed by the ATO, which we've seen many times before, and even in some instances, the issuing of director penalty notices, which can become a criminal offence if not paid. So timely superannuation payments demonstrate a commitment to the financial well-being of employees. So the introduction of same-day super ensures that employees have immediate access to the information regarding their super contributions. And that in turn fosters transparency and trust between the employee and the employer. So it can also assist in empowering employees to take an active role in planning for their future, and it instills confidence that their future savings are being managed with diligence and care by their employer. So how can employees prepare for this change? So with a commencement date of 1 July 2026, this provides employers, superannuation funds, payroll providers, and many other parts of the superannuation system with sufficient time to prepare for this change. So employers should review their payroll systems to ensure that they can accommodate the same-day superannuation contributions and adjust their cash flow practices if required. So this is more to do with the employer. And this may also involve implementing new software or adjusting existing systems to facilitate, the seamless and timely payments that need to be made. So employers should also review and, if necessary, amend their employment contracts and relevant agreements that are currently in place to reflect for the new superannuation payment timeline. So this includes like any clauses related to superannuation contributions and payment schedules, which may also need to be updated to align with the new regulatory super pay day changes. So employers, we encourage them to communicate these changes to their employees so they can feel reassurance about the timely handling of their super contributions to the respective funds. And so clear communication can help alleviate any potential concerns or questions that the employee may have. Accurate record keeping is extremely important to ensure compliance with these changes. we've heard the ATO speak over and over again about this issue, and employers should maintain detailed records of superannuation contributions, including dates of payments, amounts, and the relevant employee details. Employers may also need additional governance around these matters. And we know that there's matters such as super choice or super stapling, and the management of the remittance process, including the use of a clearinghouse to ensure that robust reporting mechanisms are in order to facilitate the transparency of these payments. So maintaining detailed records will also assist to ease the audit in the event of regulatory scrutiny. And lastly, as part of these changes, we know that the ATO will receive additional resources to detect these unpaid super payments early through various tools such as single touch payroll and super fund data matching. So in addition, the government is expected to set enhanced recovery targets for the ATO. So we highly recommend that employers conduct regular audits of their superannuation processes and also seek professional advice to ensure the alignment with these forthcoming changes, which can help identify and also rectify any compliance gaps. And we heard Ben earlier speak about how you could potentially mitigate any compliance gaps. So now let's look at some other key developments in the proposed superannuation reform. So Payday Super is only one of numerous recent superannuation developments, highlighting the federal government's focus on strengthening Australia's superannuation system to deliver better outcomes for all Australians. So one of the fundamental shifts in the superannuation landscape relates to the changing super rate. And as we know, the super rate remained unchanged at 9% for many, many years. So, however, and the first of many increases only took effect from 1 July 2013, and increases are expected to continue until it reaches 12% by 1 July 2025. So this will impact the contributions made on behalf of employees, and employers are encouraged to stay well informed of these changes to ensure compliance. Another key development is the ATO's recently revised superannuation standard choice form. Following extensive consultation with industry and stakeholders. So this updated form provides a standardized and simplified, process for employees to choose their superannuation fund, and more importantly, offers an enhanced digital user experience. So employers are encouraged to become familiar with the new form to ensure they're using the most current and compliant documentation. The ATO is also currently in the process of revising their superannuation rulings on the classification of the meaning of the term employee, and they are seeking to provide greater clarity on the criteria used to determine who is considered an employee for superannuation purposes. So these provisions are anticipated to bring about, important distinctions in the treatment of various employment arrangements, and including those for contractors and casual workers. So further updates are expected to be provided by the end of the year. Okay, so now let's talk about the much anticipated consultation paper on Payday Super. So in October 2023, Treasury released a consultation paper on securing Australian superannuation, and it sought input from industry and stakeholders on the policy and legislative design of the proposed framework. So interested parties were invited to comment on the issues raised in this paper by the 3rd of November 2023. So BDO prepared a response to the submission on the 2nd of November. So the consultation paper also provides crucial upgrades to the ATO systems for identifying and recovering unpaid super, and such things included defining payday super, updating the super charge, and compliance mechanisms. So the ATO's aim is to work with stakeholders and I guess to co-design an approach which achieves the goals of the package whilst minimising the admin and regulatory burden on stakeholders who are going to essentially implement these changes. So there's lots of work to do in this space. Importantly, we know that the super regime came into effect over 30 years ago, and it continues to be a real challenge for both in law and the way it's interpreted and applied. So it can be seen as a golden opportunity for the government, the Australian Taxation Office, and legislators to, I guess, update and modernise these rules, as they were designed at a time where there were no clearing houses, no stapled super funds, and choice of super funds. But I guess to also acknowledge the digital rules and the technological capabilities that have come into play over the last 3 decades. So I guess from a penalty perspective, employers are also or have been treated the same way as they were back 30 years ago. And this kind of seems unfair, as there shouldn't be the same penalty regardless of the level of culpability. So it's a really good chance for the ATO and legislators to have a really good think about what are the appropriate consequences to have in place in order to tackle any non-compliance in the current super landscape. The ATO, we know, are active in this space, and they try to do a lot for employers to get it right and to ensure they manage their cash flow. So we are going to see a lot more audit activity in the coming months from the ATO. So what does this mean for employers? Firstly, the importance of the quality of data and data reporting so that it's right, because the ATO are bringing in 2 big data sets to identify where employers have not met their obligations. Compliance activities are predominantly driven by employee complaints within the ATO at the moment. However, the ATO also want to proactively identify underpayments earlier, which is why I guess accurate data reporting will become increasingly important. And also, I guess from a cash flow perspective, what does this mean for employers? So these changes will also have a real impact for those employers who pay on a quarterly basis. Therefore, I guess paying smaller amounts more frequently, it means that the employers are able to keep on top of their obligations rather than falling behind. So I guess there's lots of other moving parts to the super system which need to be addressed, including clearing houses, digital service providers, super funds, and reviewing the current penalty rules for non-compliance. So there's certainly lots of hard work ahead for industry and stakeholders to provide valuable feedback on how these changes might be implemented. So now, I guess I'll pass you back on to James to conclude with any questions that may be coming from the panel. So yeah, really appreciate your time.
Thank you very much, Stephanie, and very professional in continuing on as I struggle to get the slides to catch up. But sorry for all our viewers, but your description was making it completely understandable, so thanks for that.
Hopefully, thank you.
Look, we have had a couple of questions come through, and I'll put them to the experts who are with us today. So Ben, the question that popped up is that if I think I have a super shortfall, should I immediately go and contact the ATO?
Thanks, James. Yeah, so I guess that's an interesting question in the fact that, you know, from what we were talking about before, certainly, you know, early engagement with the ATO is definitely, you know, recommended from, you know, a penalty protection perspective, as we've mentioned. I think a number of times is obviously, you know, in the event of a voluntary disclosure, it's highly unlikely that you're going to receive, you know, penalties versus, you know, in ATO initiated compliance activity, the Commission has got, you know, limited ability to remit penalties. So, you know, I think we would certainly, you know, recommend employers get on the front foot in this space. Having said that, I think it's really important that, you know, when you're going to the ATO, you have all the information, you've identified all the issues, you've done the relevant calculations, and you're comfortable that you have, you know, everything in order to effectively make that voluntary disclosure and deal with the issue that's been identified in a thorough and you know, once-off method. And you've also worked through, you know, the appropriate other issues that we've, you know, talked about today, including, you know, how you communicate with the employees and, you know, the impact that it's going to have on them.
Yeah, and that's a really good point, because I think what we've seen in some instances, it can depend on how the employers become aware of this. So obviously, if they've reviewed their payroll and identified an issue, then they probably have more information at their hands before going to the ATO. But perhaps if an employee's kind of gone to the HR team and said, hang on, I think I've been underpaid, maybe it's a heavily unionized workforce, or there's, you know, agitation and enterprise agreement about to be negotiated. So employers need to think about a whole range of issues that are happening at that time and how best to manage the engagement, both with the employees as well as the ATO. It's, I guess, not binary that you do one or the other first. Another question that we had come through for Steph, you don't miss out. So as part of the super payday scheme, is there going to be changes to the distinction between OT and super? I think Ben sort of drew out in his example that it becomes a bit more complicated if you've got a shortfall, because you're not needing to look at, you know, different elements of pay. Is that going to change in Payday Superland?
Yeah, thanks, James. And that's also a very good question. And whilst I mean that would be nice, it's not currently planned. So I think feedback on the consultation paper on there was a range of policy design elements for implementing the Payday Super, and it included things like defining what constitutes payday and whether it would capture every time a payment with an OT component is made to an employee. So for example, some payments with OT components may occur outside of the regular pay cycle, such as like termination payments. So at the moment, these are the types of questions that are being consulted on. However, that's not to say that, you know, these won't expand to other policy and other developments in the near future. So yeah, at the moment, yeah, it's not currently planned.
Okay, we'll have to manage those issues going forward still. Well, that sort of covers the questions, and I know we're a little bit early on time, but I'm sure everyone will be pleased to get at least a little bit of time back in their day. So just to wrap up, you know, probably the key takeaways from this session are this is an area of focus for the ATO. We know that government is wanting to make sure employees are getting the right amounts going into their retirement funds, into superannuation, and it's charged the ATO to manage this and make sure employers do the right thing. And it's in the ATO's interest to capture as much as they can, because they report back to the government and they look really good when they're covering it. You're recovering these amounts, and there's still large amounts at stake. So definitely focus area for the ATO. So employers need to get on top of it. They need to look at their systems, look at what they're doing as far as superannuation goes. And as Ben mentioned, if you are identifying that there's a shortfall, get onto it sooner rather than later. Don't put your head in the sand and think it's just going to go away. It's not. Manage it both with your employees and with the ATO, and particularly with the ATO, because there are limited opportunities to have penalties remitted if the ATO starts the audit, as opposed to you making a voluntary disclosure. So really important to get on top of those sorts of things. And it's a good employer, like it's good governance to be doing these things right and tackling it and giving your employees confidence that what you are doing is actually accurate. Then I guess the go forward that Stephanie sort of covered, there's still a lot that we don't know about with Payday Super. There's a lot of issues around how you manage compliance, how you manage non-compliance in a more effective way. But look, there are certainly things that employers can do now, and that's about looking at your systems, looking at your processes, because we know you're going to have to capture employee details better, their super funds better. You're going to have to make sure that your systems, your payroll systems, are set up to identify which components go into super, which might be exempt. So all of those sorts of things, which again is just really good payroll practice. You can do that sort of stuff now and know that once we get better guidance from government and Treasury and ATO around what Payday Super actually is going to look like, you'll be well advanced along the curve with having some of those basics done. So a lot of work in the super space over the next couple of years. We really appreciate you attending today's session. As I mentioned up front, this recording will be available by email. It also goes up on our website so that you can enjoy it over and over again. And just because there is so much fun stuff happening in employment taxes space, once we get over the unfortunate hump of Christmas, then we come back all raring to go for FBT. And so the next session in this Working Australia webinar series will be held on Tuesday, the 12th of March, where we'll be touching on all things that relate to FBT and compliance and getting ready. We'll cover some of the really basic issues, but most of the time we will focus on what are the key changes that have happened around FBT, what have we seen the ATO focus their attention on, so what employers need to get right. But once again, thanks very much to Steph, to Ben for their presentations today. Excellent presentations, guys. And thanks everyone for joining us today. And we look forward to welcoming you back in March when we go through FBT. Thanks very much.
Thanks.